Hello, everyone. We're moving on to chapter 11 this week, so some real like brand new material, and it's going to go over liabilities, okay? Things concerning liabilities, kind of look at current versus long-term liabilities. Again, go through the PowerPoint in the book as you always would, get the terminology, kind of the verbiage, okay? My videos will focus on the stuff you got to like see. Okay, maybe you don't need to see it, but the stuff that it would really help to see it done and have it talked through, like the journal entries. Okay, like your debits and credits for the first time back in Principles One. Okay, actually showing the steps. Okay, so again, read through the stuff because there will be content you'll need to know about other topics. Um, but these are like the big ones that you got to like see. Okay, that'll help to see. So it's really a chapter of just a whole bunch of different little liability topics. Okay, so we've really dealt with accounts payable and unearned revenue as liabilities, but we haven't dealt with many more. So that's what we're going to talk about, just little subtopics. So you're going to see here, these are a whole bunch of just little baby liability topics that we're going to look at. Okay, so first, sales tax. So, okay, we're in Pennsylvania. We have a 6% sales tax on a lot of stuff. Now, the sales tax is something that's paid by the consumer. Okay, so a person, an individual who buys this stuff pays the 6% sales tax. The company doesn't pay it themselves. They're passing it on to the customer. So whenever the company, though, they make a sale and that customer pays a 6% sales tax, the company has to account for, hey, part of this money that the customer gave me is a sales tax that has to go to the government. I can't keep all of this money because 6% of it goes onwards, okay, to the government. So the best way to see it is, let's look at this example. We're a company and we sell a shirt for $100. The customer pays 6% sales tax on the shirt. Okay. So what this means is we're selling the shirt for $100. This is where you see the price tags $100. The customer takes it up to the register. The 6% is then applied on top of that price. Okay. So we, the company, we're earning $100. That's our revenue, but we're going to be getting a little bit more because the customer is going to give us $100 plus 6% sales tax. So if we did this, okay, $100 times 6% is $6, right? And I'm just showing that so this way, if you have uh, more bigger numbers, that's fancy. If you have other numbers that are harder to calculate, you see to get the sales tax itself, it's the sales price just times the percentage. Okay. So the sales tax is $6. Okay. So here's how the company would set this up. Either it's on account or we are receiving the cash today. Okay, one or the other. Okay, since it doesn't say on account, we'll assume the debit will be cash because we, the company, are going to be receiving cash. And how much cash are we receiving? The $100 for the shirt plus the $6 additional for sales tax. So we are receiving $106. Now, what do we do when we make a sale? We credit sales revenue, right? We're not worrying about the cost of inventory because we just want to focus on the liability side of all this. So we're recognizing the revenue of $100. And then you see, all right, well, we don't balance. Okay, rules of journal entries being broken. We need one more credit of $6 for this to balance. And that credit goes to sales tax payable, the liability account. Sales tax payable is a holding account. So we're saying, hey, of this $106 we just got of cash, $6 of it we have to send on to the government. Okay. The reason it goes to a liability account is because companies are not constantly sending little baby sales tax payments to the government. Okay. For every $6 that they're getting right here, they're not constantly sending it. They normally send the sales tax quarterly to the government. So whatever their accumulated sales tax payable is, okay, they're going to have a T chart going. Whatever that balance is, generally quarterly, that full balance, they'll then send as cash. So when they do send it and they do pay the government, again, whatever the total balance is, they're going to wind up debiting sales tax payable. Okay. And since we don't have a whole bunch of entries, we just have one. For this case, it'll be just that $6 and they'll credit cash $6. So it's going to cancel out. Okay. So again, a lot of these I'm not going to spend like a super time with because they're straightforward, just little concepts again. Okay. So let's move on. This will be the biggest concept probably. Notes payable. We might have talked a little bit in principles one about a note payable. Basically, what a note payable is a longer term loan, okay, compared to an account payable. Account payable, again, remember for principle one, an account payable is liability where we purchase something and we're given a little bit of time before we have to pay for it. But by a little bit, I mean up to 3 months max, generally, is an account payable. Once you're given more than 3 months, okay, this isn't like a set in stone rule. It's just for the most part, when you're given more than 3 months to pay for something, then it becomes a note payable. And the difference is once it has that label note payable, it comes with interest. You have to pay interest on it. Okay. So for this example, now you could get a note payable. You could go to the bank and get a loan. And you could say, I want a $10,000 loan. They give you $10,000 cash. Okay. And then the other side of it is you recognize a note payable that you have to pay this back at some point. Okay. Straightforward. Another one is sometimes when you make a purchase from another company, they might give you an accounts payable to start where they say, all right, you had 3 months to pay us. But then let's say after 3 months, you're like, hey, we really need more time. The other company is like, all right, fine. But since it's so long now, we're going to start charging interest. Okay. So that's what we're going to look at because that's the harder version. So we have an accounts payable that's going to turn into a note payable. We have a $1,000 account payable with a company that turns into a 6-month note payable. There's 10% interest due at the end. Okay. So let's say we're doing this on January 1st to start. Okay. Because we're going to look at another scenario. So January 1st. Okay. We're turning the $1,000 account payable into a note payable on January 1st. So think about it. Right now, we have a credit in this account payable account for $1,000. What's going to happen is we're going to debit accounts payable for $1,000 and we're going to credit note payable. Okay. I'm just abbreviating it. Actually, for the note payable, since it's our first time, I'll make it long. Okay. But we'll start abbreviating. So all we're doing is we're transferring it from one type of liability to another. We're saying it's no longer an account payable. It's now a note payable. Okay. So that's on January 1st. Now we have 6 months to pay it, and there's 10% interest that comes with this. So 6 months later, when would that bring us? We have January 1st is when it starts. So February 1st, 1 month, March 1st, April 1st, May 1st, June 1st, July 1st. So July 1st, okay, 6 months later, what do we need to worry about? We need to pay off the full balance and interest. Okay, so that's something you got to keep in mind with note payable. Okay. So we know we got to pay cash. We know we need to eliminate the note payable, right? So here we could start setting it up. We have to get rid of the note payable. If we're paying it, this note payable that was credited for $1,000 needs to be debited. Debit the note payable for $1,000. We know we need to credit cash. Okay. So we need to credit cash, but we don't know for how much yet because it's going to be this $1,000 plus the interest. Okay. And we know, okay, since we're paying interest, okay, what is interest? Interest is an expense. So we're going to recognize interest expense. So that's what we got to figure out. Okay, interest expense is debited because it's an expense, like all expenses are debited. We need to figure out how much we're debiting interest expense for, and then whatever that is, that plus the $1,000 is what we're going to credit cash for. So how do we calculate interest? Okay, I'll put it as steps, and maybe you don't need all these steps, but I'm going to do it as broken down as possible. So first, the biggest thing is whenever you see one of these problems and they say interest, the interest they're telling you is generally yearly interest. So when you see this 10% means that it's 10% interest for the year. So this is why it's a little confusing, but I'm going to teach it this way because you're going to see it listed like this in every book, problem, PowerPoint resource. So you see these interest rates, they're yearly rates, okay? But if you look, we're not holding this note for a year, okay? So this means 10% interest for a year. We're only holding it for 6 months. So the first thing I always say to do is calculate the monthly interest rate, okay? Calculate the monthly interest rate. So if 10% is the yearly interest rate, what you do to do this is you take your interest rate divided by 12. So in this case, we got 10% divided by 12, and we get 0.00833. If we put that in a percentage, okay, and then we don't want to round it too much, okay? If you're going to round it, do it to at least the second decimal, the 10th place. So 0.83%. That's the monthly rate, okay? Now, okay, we can use this into one big formula. So the big formula, so second, figure out total interest. So to figure out interest, here's a little parentheses. The balance of the note multiplied by the monthly interest multiplied by the number of months. So that's the formula to calculate the interest expense. So let's look at it. Equals the balance of the notes, $1,000, times what's the monthly rate? We just calculated it up here. Times how many months did this note last? 6. So $50 is our interest. Okay. So now we're going to take that and we're going to put it over here. So 50 is our interest expense. And the cash we're paying now is we're paying them the $1,000 we owe plus the $50. So we're paying them a total of $1,050. And that's a note. Now let's say, here's what we're going to change. Let's say, and I'll scroll it over here. Let's say instead of taking this note on January 1st, we took it on October 1st. So now remember the big thing with GAAP, okay? Remember that accrual accounting we learned. Expenses have to be recognized in the period, which means the year they are incurred, okay? So whenever we incur an expense, okay, we have to recognize it in the year it belongs in. So when we have a note, okay, every month that note passes that we're accruing interest, so like interest is building on the note, we've technically had interest expense for that month. We don't need to recognize the interest expense every month, but once we get to the end of the year, okay, even if we haven't paid the note yet, we have to recognize interest expense for the part of the year at the time that we've held this note, okay? So like I said, let's say we're taking this note on January 1st. Instead, we took it on October 1st. So on October 1st, it's the same thing. We're going to debit accounts payable, 1,000, and we're going to credit note payable, 1,000, right? Now, okay, again, it's a 6-month note. So we don't need to pay the note back. Okay, think about it. November 1st, December 1st, January 1st, February 1st, March 1st, April 1st is when we have to pay it. Okay, but the year ends on December 31st, right? So on December 31st, okay, when the year ends, we need to recognize the interest expense that was for that year. Okay, so on December 31st, when the year ends, part of the interest is because we held this note, half of it, okay, or for half the time that was in another year. So we can't recognize all of the interest expense on April 1st, okay? Say it's April 1st, 2022. Well, we weren't holding the note for all of 2022. We were holding it for part of 2021, part of 2022. So the interest, part of it has to be put towards 2021, part towards 2022. So when we do this, it's going to be on December 31st. We're not paying any cash. We're not paying it. We're recognizing interest expense, though. We need to show, okay, and I'll put the debit words, debit interest expense, okay, that we're recognizing part of this interest, okay, right before the year is over. That's why we're doing it on December 31st, part of this interest expense. And what do we credit? If we're not paying cash, we're going to credit, this is where the liability comes in, interest payable. A liability saying, hey, we're recognizing we have to pay part of this interest. We're not paying for it this year. We're just recognizing the expense this year. Okay, so here's some new accrual accounting for us. So now, how do we figure this out? Well, we could do the same method we did over here. Okay, we already calculated the monthly rate, 0.83%. So now, what we're saying is, all right, at this point in time, what's the interest? So the full balance of the note, $1,000, times the monthly interest rate, 0.83, times how many months have passed up until this date. Okay, we took it on October 1st, so October 1st to November 1st is 1 month. November 1st to December 1st is 2 months. Since we're at December 31st, all of December has passed. All right, so we're going to say that's 3 full months. Okay, that's how it works. It's 3 full months. So we're going to do times 3. Okay, and that should be $25. So that's what we're debiting. We're saying, all right, of this interest expense, 25 of it belongs in this past year. Again, let's say it's 2021. Now, when we pay the note on April 1st, okay, so now we're paying the note. So what has to happen? One, we need to get rid of the note payable. So we're going to debit note payable. And that we know is for the full $1,000. What else do we need to get rid of now? Think of everything that exists and think of everything that needs to go. We know we need to credit cash, okay, but we're not there yet because we want to make the journal entry line up. We look at this though. We have a credit to interest payable, another liability. So this interest payable is tied to this note. We need to get rid of this interest payable. So we're going to debit interest payable, $25. Okay? So we got 2 debits right now. But now it's April 1st. Have we recognized the full interest expense yet? No, we haven't. We've only recognized 3 months of it, right? October, November, and December. Now January, February, and March have all passed by. So there's 3 more months of interest we have to recognize. So we're going to debit interest expense. Okay. So how much more interest expense do we need to do? Okay. Now we could technically see, because we did this both ways, in total we were supposed to pay $50 in interest. We've already accounted for 25, so we need to account for 25 more. Okay. Or we could do it this way, like we did here. We say, all right, well, 3 more months have passed. So let's do the long way. Total value of the note times the percentage, 0.83, times how many months have passed, January, February, March, 3 months. So $25 more has to go to interest expense. And now, how much are we paying in cash? Remember, we never paid the cash on December 31st. We recognized the liability. So we're paying all the cash now. So the $1,000 for the note plus $25 from the interest payable we recognized on December 31st, plus $25 of new interest for this year. So in total, it's $1,050. Okay. So you'll see the cash doesn't change. Okay, and the note payable doesn't change. It's just depending on the time frame, we might have to debit interest payable and interest expense. Okay. So that's notes. Let's move on 2 more topics. Now we get to warranties. Warranties, think about it. You buy something generally like a big product, like a car or a utility, an appliance, like a refrigerator, something like that. They come with warranties on it to protect you. And maybe you got like a year if something goes wrong. Well, when companies sell these things, okay, GAAP tells them to estimate on average per each item they sell, how much do they usually have to pay for warranties? Okay, because it's very similar to, think of when we were writing off accounts receivable using the allowance method, when we had to estimate, okay? Remember, when we estimate accounts receivables that we don't think we're going to collect, okay? We have no official word from customers we're not collecting. We're making an estimate. And what do we do when we make that estimate? We recognize bad debt expense and we credit that allowance for doubtful account. Okay, because again, we want to make sure the expense is recognized in the year it's for. Okay, so with this, what we want to do with a warranty is we want to recognize our estimate of warranty expense when we sell the item. Okay, when we sell the good. So look here, we have a company that's selling a $20,000 car. On average, $500 of warranty repairs are needed for every car they sell. So whenever they sell a car, on average, and it could go up or down, but we're just making an average, $500 is what the company has to shell out to fix the car, okay, for every car. Some cars, it might be nothing. Some cars, it might be $2,000. On average, it comes to $500 a car. So what this company has to do every time they sell a car is they're going to recognize a debit to warranty expense, okay, because this is going to be an expense to them. So they're going to debit warranty expense for this average, the 500 bucks, and they're going to credit, okay, a liability, warranty payable for $500. So it's pretty straightforward. Then what happens? All right, let's say a customer does actually need repairs. Okay, so a customer does need the repairs. Okay, and it comes to, let's say it just comes to 300 bucks. That's fine. What's the company going to do? They're going to debit warranty payable because they've already accounted for they might need to pay some of this. So they're going to debit warranty payable for 300. And let's say they use cash to pay it, they're going to credit cash for 300. Okay. You might see like inventory credited if they need to use like parts to repair it. They don't, like, you could bring the car to that business and they'll repair it with their parts. Then they're not paying cash, they're using their inventory. All right. But either way, okay, credit cash. And it's fine that it's not the full amount. Okay. And you don't have to readjust it. You don't have to do anything like that. All that has to happen is, let's say this keeps happening. We make the average $500, but it just never, all the warranties, whenever customers come in to claim them, they're always below 500. Generally accepted accounting principle says, all right, next year, readjust your estimate, lower it, and that's fine. That's all you do. You don't have to touch this account. You don't have to undo this entry. You're fine. Okay. And now the last part is a big topic called contingent liabilities. So contingent liabilities are what happens if we think we're going to have to pay money for something, but we're not 100% sure. Okay. I'm just making these bold. So that's a contingent liability where there's a chance you're going to have to pay for something, but you're not sure on how high that chance is. Okay. And there's actually three different ways you handle this, depending on the probability of the liability happening. So what a good example of contingent liability is, one that we always go to, is pending lawsuits. So your company is being sued and you don't really know for sure if you're going to win or lose. Okay. So pending lawsuits, think of a lawsuit. We're being sued. We're being sued for $50,000. So the first thing you have to do is you have to ask yourself, what is the chance that this is going to happen? We're going to have to pay this. So remote, okay, and you can see the definitions of these, but I did want to discuss this topic. Remote is very little chance, generally less than 50%. So remote would be, all right, we think we got this case won for sure. Okay, we're fine. We weren't in the wrong, whatever they're suing us for. We don't think at all that we're going to have to pay this. So if that's the case, we do nothing if it's remote. Reasonably possible. Reasonably possible. Now, these last two, it gets a little gray. Reasonably possible means there's more of a chance we're going to have to pay than not. So really, okay, we're thinking anywhere from a 50% chance to maybe 75%, okay? It's a 50 to 75% chance we'll have to pay. In this case, okay, again, it's not guaranteed. We still have uncertainty. We're like, maybe we're hopeful, but we're not sure. So whenever we constitute that this is a reasonably possible payment we're going to have to make, we don't do a journal entry, but we add a note to our financial statements. So notes to the financial statements, okay, when you look at a company, they publish their annual report. And at the end of, not at the end, but after they show you their financial statements in the annual report, there's a whole big list of like words. Like they write paragraphs and paragraphs where they highlight important information that the financial statements alone can't tell you. And what they would do is, in this information, they would say, hey, just so all you potential investors know, there's a good chance we're going to have to pay $50,000 towards a lawsuit. Okay, again, there's no journal entry, no accounts are made, but they're making you known of it just in case. Okay, since it's reasonably possible. Now, let's say probable. So probable is, yeah, okay, this is happening. We know it's going to happen. We know we screwed up. We know we're being sued. It's going to happen. There's two little subcategories for probable. The first one is, all right, if it is probable, do we know the amount for sure. Okay, because sometimes the amount's uncertain. So what I should say is the amount certain? Okay. If yes, journalize, make a journal entry. If no, add it to the notes. Okay, just like reasonably probable, we would just make a note about it. And we would say, all right, it's probably going to be anywhere between, $30,000 and $60,000 that we're going to have to pay for this, but we're just not sure. But let's say it's probable and we know the amount. We know for sure it's $50,000. Okay. Well, what would we do? We would recognize again, accounting is all about recognizing expenses in the year they occur. So let's say it's 2021, we're being sued. What we want to do is we want to recognize an expense, okay, for this. And what we're going to do is we're going to recognize the liability saying, yeah, we're probably going to have to pay this. Okay. Now, there's really not like a clear cut, like fancy account. What we'd probably do is we would debit, you could say legal expenses or even lawsuit expense. Again, we want to categorize it so we know exactly what it was. So let's say it's lawsuit expense for 50 grand, and we're going to credit lawsuit payable. Okay, anything that like lets you know this is for a case. Okay, maybe you want to say litigation. I don't know if litigation is really the correct word, but something of that degree. Okay. But again, so the only time you make a journal entry for a contingent liability, which again is a liability we're unsure of, is if it's probable. So again, we're looking at greater than 75% about, okay? Is it probable and do we know the amount for certain? Okay. So those are the main topics. You're also seeing this chapter payroll tax stuff and payroll stuff. We're not going to dive into that because that's a real specialized area of accounting. Okay. We're not going to look deep into the journal entries of that. You will be asked some questions in certain activities regarding like generic payroll stuff. So read about it. Okay, be familiar with it, but we're not diving in. Okay, I'm going to end that there.